The thing that most people don't realize is rates drop when there's stress in the economy. So if they drop rates, that is good that we pay less interest, but that is a huge red flag that we see fracturing in our economy.
Good morning, Mike. It is July 31st. Today, the federal funds rate adjustment, or maybe not adjustment, is getting announced by the Fed at 2 o'clock this afternoon. We are recording before this just to talk about what the Fed funds rate is, why it's fluctuated, what are the economic impacts that adjust it. But I want to start out with, what is it? Why do we have a Fed funds rate? What does the Fed do? And why does it adjust?
So the Fed fund rate is basically a window of a rate, a range. And that range is kind of what sets what banks can borrow or should borrow between each other at. So right now it's at 5.25 to 5.5. So in theory, a local bank here where I live, they need to borrow money to make a loan. They'll go to Chase or Wells Fargo and say, hey, we need to borrow $5 million. They can expect to pay within that range of 5.25 to 5.5 to borrow that money from, say, Wells Fargo. So then they're going to lend it to me at a spread difference. And the reason, that we have that as well is to create stability. So when that bank is making loans with me and making, statements of this is the rate we can do, they know in general what they can go borrow that money from another bank for. Where if they were saying, hey, we can lend it to you at 7, and then they start shopping around to other banks and they say, hey, we're charging you 8%, they just promised me 7 and they can't get the money. So they need stability in knowing what they can actually borrow money at.
That makes sense. And really the Fed's responsibility, right, is to just maintain a stable economy, keep up with current economic conditions. The Fed rate, they set it, right? There's a set rate, and really over the last, about the last year, they haven't really adjusted it too much. Let's go to the 80s, because people today say, hey, interest rates are crazy. They're higher than they were 3, 4, 5 years ago. Let's go back to the 80s. Talk about what the Fed was doing in the 80s when they were setting that Fed fund rate, like why it was so high, and then what they did to bring it down.
So let's go back to the 80s, and we have hyperinflation, money's taking off. So what $100 could buy today, short time after that, you need 120 to buy that same thing because inflation is just taking off. So in order to tame that inflation, so it doesn't turn into what $100 today buys, you now need 200 and now you need 500. The Fed set interest rates very high, which forces economics to slow down in the country. And then when that slows down, that demand slows down and the prices stabilize. That's the hope of it. The Fed and kind of the economic policy, though, it wasn't very long prior to that we had come off the gold standard. So now there's kind of no set physical asset that the currency is tied to. So it was a different world back then. Love the saying, history doesn't repeat itself, but it rhymes. So we need to look for clues. But the Fed and all the people today, they have way more data today to use because they've seen how past Feds have handled, how past economies have worked, what happens in a recession, what happens when you do this, how does the economy respond. They have this data now, where previously they didn't have this data. They were going totally on theory and making a best guess and hoping that it worked out. And we're still doing that little by little, but the goal is that every year you gain a little bit more clarity. Obviously, we have computers and AI now that can crunch all of the data and say, here's exactly what happened 20 years ago when they raised rates. Here's exactly how it affected. Here's all the numbers. Here's a summary. I mean, to crunch all that numbers and all that data in the 80s would have been almost impossible. So, it's comparable. We got to consider the past, but it's more of a rhyme than a repeat for the future.
Absolutely. And I asked the question of going back into the past just because I want to give a better understanding for people who are watching to know that there's got to be, it doesn't have to be, but there's typically some type of historical event that happens that forces the Fed to adjust, right? They're there to keep up with inflation, to, again, keep stable economic policies, but there's typically an event. There's the hyperinflation in the 80s. We get early 90s. There's the Gulf War. We get to the dot-com bubble. We get to the 2008 housing crash. Like, there's always events in history that happen. Talk about what the power that the Fed has to make these adjustments to the Fed rate to kind of counteract these events that happen.
Yeah, so when these events happen, the reality is all of these events, when they occur, they create simply instability in the economy. So the Fed's job is to try to restabilize the economy. So for instance, in the '08 crash, banks are going out of business. There was concern of, oh my God, we're going to lose all of the money. We have money invested in money markets. That money may all go away. So all this instability and fear within the American people creates bank runs and creates instability within the market. So the Fed's job is to restabilize that. So the Fed does one of two things. They have quantitative easing, where all these assets, they will just print the money in theory and buy these assets. So the bank doesn't have to hold it anymore. The bank gets a cash infusion and it stabilizes that concern in the asset class. The other thing they do is adjust those interest rates up and down. So during a time of a crisis like the '08, they take the interest rates way down to make borrowing very easy. So if you're in a pinch, you can go borrow money at roughly 0% to stabilize, and you don't have to be concerned about that. More importantly, banks and big financial institutions that are in a pinch during that crisis, they can borrow at almost 0% to basically buy their time through this crisis, not, accrue a bunch of interest. And then when we get to the other side of this crisis, they can stabilize things out. So that's the Fed's job, is to try to give these institutions and the American people time to get through that crisis without creating a ton of chaos.
Yeah. I mean, in the middle of 2008, the Feds dropped the funds rate down their range, right? Because when we say federal fund rate, that's truly a range. It's not a specific percentage. Their range was 0 to 0.25. You're right. The banks could essentially borrow money at 0%. You were starting to buy properties back then. What was your interest rate from a bank? Call it end of 2008, early 2009.
Oh man, I don't remember that far back. But if we use COVID example, more recent example, we had mortgages, 30-year mortgages that were in the low threes, sometimes a high two that we would get. So typically you're going to see on investment property, it's going to be a slightly riskier asset for the bank. So they're going to want a little bit more spread. But I mean, you can expect to see about a 2 to 3% range there. So if it's at 0 for the federal funds, and that's what banks can borrow money at, they're typically going to be, between 2 and 3 on what they're lending it back to you. That's a spread that they want to make on their money. So right now, if we're in the 5.25 to 5.5, I mean, you can just expect that it's going to be basically around 7.25 up to maybe even 8.25 for certain borrowers. And it's always going to have that margin there because that's where the bank makes their money, is on that margin.
Yeah. Is there any investment strategy? Because to be honest, a lot of people probably don't pay attention to the federal funds rate. Like 70% of America is not even going to know that the federal funds rate announcement is happening this afternoon, with Chairman Jerome Powell. But if you look at the last, let's say, 2.5 years of what the funds rate has been, as early as March of 22, you were looking at 0.25 to 0.5, right? We're just kind of coming off COVID. We're trying to restabilize, invigorate the economy. But then just like a year later, March of 23, we're at 4.75, right? And people feel that because that's when people are wanting to borrow money. And a lot of people will say, well, shoot, I missed my opportunity by not borrowing in 22 and now it's 23. What would you say to the average American, the listeners of this show, that the federal funds rate is important? And why?
I mean, the federal fund rate is important because it's going to affect your savings account, what you get at your savings, because basically the savings work by, if the bank can borrow money at 5.25 to 5.5, the other place they can borrow money is from you, which is your savings account. So they'll raise savings accounts to maybe be 5%. So because they can borrow at 5.25, 5.5, they'll tell you, what if you put your money with us and we'll give you 5%? That's a slightly cheaper access to money for them. So all of these things kind of go around and depend on the federal fund rate. The federal fund rate, you could argue whether that affects bond prices or bond prices affects the federal rate and the Fed's decision on whether to raise or lower the rate, but it's going to affect all the bonds, the set income type investments that are out there. And then the most important thing is going to affect the borrowing. If you're buying a house, let's call it a $500,000 house or call it a $10 million apartment, the difference between 3 and 4% or 6 and 7% is astronomical in interest payments. So it makes a huge difference.
What does it mean for banks when they're trying to loan to each other? When there's a slight adjustment, like today, like you said, it's 5.25 to 5.5. Let's say they lower it by a quarter. What does that mean from a bank to bank transaction? I know banks give each other like ultra short-term loans, like overnight loans to each other, $5 million, for example. What does that margin mean from a bank to bank situation? Why do banks like it?
The reality is that banks don't all have this cash. When you go borrow, when we buy an apartment complex and it costs $10 million, they don't just have $10 million in cash and just say, here's the $10 million. They issue the loan to us, but it's all just numbers on a computer. So when they issue the loan to us, they're really going behind the scenes. They're either pulling money from savings accounts, which would be actual cash that they have there. They're selling assets to get that cash, but more times than not, they're just going to a larger bank that does have that 10 million and they're borrowing that money at a similar type of interest spread. So for instance, if we borrow 10 million from a bank for a 5-year fixed note, in theory and in general, what they're going to do is go to another bigger bank that has that 10 million. They're going to lock that 10 million in for 5 years at 5.25, and then they're going to lend it back out to us at 7.25 for 5 years. So they just locked in a 2% spread there for the next 5 years.
That makes sense. How does inflation play a role in all of this?
So inflation is kind of the risk factor of why they don't drop rates to zero. So rates being at zero creates huge economic growth. The problem is when money is almost free and the rates are at zero, instead of paying interest, for instance, on your money, you're just losing value in your money because inflation starts to take off. So when money is at 0%, you almost have unlimited access to money. There's really no risk besides the principal. And therefore, people start hiring a bunch of employees to try to grow a new product line or grow a service. They start investing all this money because they can make a spread. If they're borrowing at roughly zero, all they got to do is make 2 to 3% on an investment to have that margin there. So they start making riskier investments because it's not that difficult to cover 2 to 3% spread if you're borrowing at zero. But all of this creates a ton of supply of money in the market. So when the supply rises and we have all this money, people start spending like crazy. And when people start spending, when buying things, prices just tick up and up and up. And all of a sudden, what costs $100,000 today? Let's say a house, '08 housing crisis, costs $100,000. All of a sudden now that house costs $300,000. I am super excited to introduce to you the Doctors and Dollars 5-Day Financial Challenge. I'm Mike Neubauer, I'm CEO of Grand Vision Companies, and I'm the one that you see on the Wealth Wednesday and Daily Dollar episodes with Nate. So Nate and I are partnering again to do something even more exciting, which is the 5-Day Challenge. We're taking the best of all of our episodes, all of our expertise and knowledge, and we're condensing it into an impactful and purposeful 5-day presentation, 1 hour per day, for 5 days to give you everything you need to build that foundation for your financial future. So if you're looking to gain the pieces, you want those puzzle pieces and find out how they fit in your financial plan, head over to the Doctors and Dollars website, join us on the 5-day challenge. We're putting it together for free, so you got nothing to lose. We look forward to seeing you on the inside. So these prices can tick up very quickly. That's what we saw in COVID. Everybody started getting unlimited unemployment and they started getting money in their bank accounts. All this money started hitting accounts. And granted, some people needed it, but it was a blank check to everybody. So I didn't necessarily need it, but I still got the check. And because I got the check, I just went and invested that money or bought something that I otherwise wouldn't. And because that new money is in the market, prices start swinging up. And now you got to rein it back in and try to pull some of that money out of the market so that prices come back down. Competition kicks up and somebody says, for instance, I could drive this used car another year. Money's tight right now. Interest rates are high. I don't need to go buy a new car. So now the sales on cars start dropping and now they have to start discounting and offering rebates and actually competing with other manufacturers. And all of that slows economic activity, which also slows the inflation rate.
Yeah, that makes sense. There's always an ebb and flow, right? Like even the example I gave earlier was like March of 22 to even March of 24, like just the range there that the Fed funds rate has adjusted. There's just an ebb and flow. If you look at the historical chart that we shared earlier, there's always the up and down. Historically, and I think even today, the Fed's desired like target inflation rate is like 2%. So let's say inflation drops down to 2%. It hits the Fed's desired target. What's that Fed fund rate look like?
So, I mean, the Fed fund rate is dependent on what rate keeps us around that 2% range. So if we drop rates to 4% and that holds inflation around 2%, they'll pretty much stay steady. If inflation starts dropping down to say 1%, all of a sudden rates will drop to try to push inflation back to 2%. So that's how it works, is they keep adjusting to try to see what number range keeps us around where we want. However, realize too that just what the Fed says doesn't necessarily mean that's what it's actually trying to do. So because we say 2% inflation, that doesn't mean when they go behind closed doors, they actually try to hit 2%. They just say it's 2% because what people don't realize is as much as they would like to be at 2%, they definitely do not want to be at say 1.5%. The risk of deflation and lowering prices is much riskier than being at 3 or 4% inflation. So as much as they're trying to tame inflation, it's a fine line to not push too hard and put us into deflation because the theoretical economics of that would be a tailspin into recession and depression. As if prices start dropping, people stop spending money because their money is more valuable tomorrow. So just holding cash tomorrow, it's more valuable. And our economy is not built to run in that theoretical economic game plan. So they really do not want prices to drop. They would just like them to stop rising so fast.
Gotcha. That totally makes sense. And what I was envisioning there was you were saying that is for most Americans that they do want to pay attention to the inflation number and the Fed fund rate number to then pay attention to what they can go borrow money at. It sounds like kind of a stair step, right? Like if inflation's at 2, the Fed fund rate could be at 4, you can borrow money at 5. Am I tracking correctly with my thought there?
Yeah, in general, and these ranges are always adjusting because, things happen outside of our control, world politics, wars, everything. So it's always got to be a fine line and adjusting. And we're getting reports. The problem with like our inflation reports is they're a little bit kind of made up because they just remove things that don't fit their criteria and they add things that carry more weight. And what we spend money on may not actually be what they're tracking as far as inflation. Inflation in my daily life may be much higher or much lower depending on the things that I buy because they're grabbing a general swatch of information and data and saying this is what the inflation is. So it's always adjusting. But in a perfect world, yes, in a perfect world, all of a sudden you hit that magic number. Let's say the Fed rate is at 4. It keeps inflation right at 2%. Everybody knows that they can pretty much borrow at 2 to 3 points above that 4. So borrowing is going to be around 6%, and it just goes like that forever. Of course, things are always changing. That's why we always talk about adaptability. But in a perfect world, that would be amazing to have that type of stability in the economy.
Yeah, you made an interesting point earlier, and I definitely want to ask on this. And you probably didn't think I was going to ask you this. How does world economics affect the American Fed fund rate? Meaning, how does the European Union, Chinese markets, the war in the Middle East, South American agriculture, like all those different factors around the world, what impact does that have on the Fed's decision to adjust or not adjust the rate at any time during the year?
So we won't ever know any of this is fact because they never say like, hey, this is why we're doing it because, we're mad at China. But it plays a huge role. I mean, realistically, we live in a world economy. We're a large portion of the economy, but we're not the whole portion of the economy. And we don't realize most of the time living in America how connected all of these countries are. So the Fed fund rate has a huge impact on these other countries, and the economies of these other countries have a huge impact on us. So I would say for right now, as an example, China is kind of an access to us. They're more of an enemy than they are an ally. Our economies are battling. China is trying to flood the market, worldwide market, with cheap goods because they have a backup of all these goods and they're trying to get rid of them as cheap as they can. The Chinese government is subsidizing a lot of these. So let's say if you sell a product for $100 or it costs $100 to make a product, they'll sell it at 80. So they're losing $20 every time they sell that. Well, the Chinese government is just subsidizing that to cover that. So that allows the company to flood the market with super cheap products that nobody else can afford to make at that type of price. So it crushes other economies. So things like that are happening in the world all the time. The US does respond. They just issued tariffs, and that's one way. But the other thing is by holding Fed fund rates at a certain range, they can put pressure on other economies because they can maybe hold rates higher and our economy can withstand that economic fight for a little bit longer. And by us holding higher, money starts to leave China and flow into the US, and it hurts their economy and keeps pushing it down, and they'll break before we break is the theory. And then on the other side, you have the allies, and you want to make sure they stay built up. So they're going to have conversations and say, here's what we're looking at. We don't want to make fractures in these other economies. Let's call it the UK, for instance, Germany as an example. We don't want to fracture Germany, so we have to pay attention to what our Fed fund rates do, because if we start sucking money out of Germany like we are China, it can cause that same economic hardship in Germany. If investors and big amounts of money start flowing to buy U.S. treasuries because they're 5.25, and Germany can only afford to do, say, 4.5, people are going to go to the U.S. and get 5.25 on their money rather than 4.5, and it starts to pull money out of these countries. The other thing is most of these countries have debt as well that's denominated in U.S. dollars, so they need U.S. dollars to pay that debt. So if you have a loan or you buy large amounts of oil and you need to pay in U.S. dollars, the value of your US dollar compared to what your currency is plays a huge impact in that. So not to dive into all of the details, but our currency and our Fed fund rate does have a huge effect on the world. And it's not just us making the decision, it's us making the decision based on what countries do we like and do we want to see them struggle, and which countries do we not like and we want to force some pressure there, and which countries do we like and then we don't want to push too hard that we cause fracturing on them with our decisions here in the US.
That was fantastic insight. That was really good. I even learned a little bit there. So that was an awesome answer. I go back to borrowing, and we'll keep it world economics. People borrow money, like you said, in the dollar, right? To buy oil. Like you can't buy oil unless it's in the dollar. Is there kind of the inverse where the United States is borrowing money from other countries in their currency to maybe offset the value of the dollar and then again adjust inflation, which then in turn adjusts the federal fund rate?
Yeah, so I don't know the exact details of who owns what, but this is when you talk about kind of the reserve currency. currency. So the US is the top reserve currency right now, but there are others that people hold as reserve currency. So that would be what we're talking about when they buy US dollars to hold them as a backstop to their currency, or they buy Chinese yuan to hold as a backstop. So all these countries do that. They're always looking and saying, I think our money will rise or fall compared to this currency, or this country is a very stable country and trustworthy. So we're going to hold their money as our asset rather than pick something like Zimbabwe, or Venezuela, which has inflation and things going all over the board, no stability. People are not buying those currencies to hold as assets because it's too unstable. So all of the countries are buying different currencies based on their risk profile and what they want to hold as a secure asset. I would assume the US does the same and holds some other country as reserve currency.
That makes sense. What are some final thoughts? As the announcement is today at 2 o'clock, we're recording, call it 10 a.m. here on July 31st. I don't see them adjusting it. They haven't moved it yet in 2024, and we're halfway through. I think they'll just keep it the same and say, hey, there's not enough play in the markets. There's not enough economic, different things that are coming about that we need to change it. What are your thoughts on what their announcement this afternoon is going to be?
So a few things. I don't think they're going to change this time. Typically, if they're going to make a change, it's usually pretty obvious in the news prior.
People
their
see it
remarks
coming
and ideas. Yeah, so I don't see that coming. I do probably see September. I do see that the economy is starting to struggle. I mean, you see it in personal life, you see it in the data. Here's the final kind of idea for it. People don't realize that as much as I would like rates to drop, because we could refinance, we can buy apartments at lower rates and have better returns. I would love to see rates drop. The thing that most people don't realize is rates drop when there's stress in the economy. So if they drop rates, that is good that we pay less interest, but that is a huge red flag that we see fracturing in our economy. If we had no red flags in our economy, they would not drop rates. They're not just going to drop rates because inflation's coming down and this is so great. They're going to start dropping because they have stressed the economy so much that they've realized we can't stress it anymore. We have to drop now. So that's kind of the idea of right now, bad news is good news. So unemployment numbers get worse. That's good news because they're going to drop rates. The economy is slowing. That's good news because they're going to drop rates. But that's actually bad news that's happening to our economy. So when bad news stops becoming good news and all of a sudden bad news is just bad news and they say unemployment's through the roof and all of a sudden you look around and say, oh my God, this is actually affecting people's pocketbooks. Now unemployment isn't just for rates. It's actually a problem. That's that fine line of dropping rates is you only drop rates when there's stress on the economy. It's not necessarily a good thing to drop rates because that means we're struggling in some area. And the reality is the American people, we don't typically see that struggle as far as the data until the rates drop. And then all of a sudden it's like, whoa, Bear Stearns just closed and went out of business. And oh my God, all these banks and foreclosures. I mean, all of that information's coming prior. So when you see the rates start dropping, you know that something's on the table.
Yeah, that's great analysis, Mike, because I think a lot of people do think of the positive. They're like, oh, my rates are going down. That house that we weren't going to get, maybe until next year. We've been waiting for rates to go down. Now we can go out and borrow money. Interpersonally, that might be a good thing, but from a macro standpoint, that's a red flag. I think your analysis there was spot on that people need to look at both sides. Yes, it can benefit you personally in a very singular situation, but in a much larger economic view, it may not be the best. So that was really good insight. It is the end of the month. We will be back.
Real quick, let's use that as an analogy. So if rates drop and you're excited because you can buy a house at cheaper now, that's great, but not if you lose your job the next day. So that's what people don't realize is that stress in the economy, they get excited and depending on where it falls, like, ooh, rates are lower, I'm going to go buy that house. And then they walk into their job and the boss goes, hey, we're struggling here. We've pushed for too long. We have to make cuts. You lost your job. And all of a sudden, bad news being good news yesterday, bad news is now actually bad news today. And the drop in rates doesn't matter at all because the stress on the economy costs you your job. So at some point, that's that soft landing they talk about is trying to push all the way right to that edge where it doesn't affect people's livelihoods, but it keeps inflation down as long as possible. So that's kind of the analogy that when I say bad news is good news or bad news is actually bad news, that's what I'm talking about.
Yeah, well said. All right, we'll wrap it up. We'll be back tomorrow talking about the headlines, giving you the no BS point of view.
See you, buddy.